is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, and here's what's coming up on today's programme. US headline and core CPI readings will be pored over for clues on the course of Fed interest rates. Equity and Treasury moves are muted before that report. Hike versus hold, Fed officials signalled divisions over their next policy decision. Plus, sources say big US lenders that shored up First Republic Bank last month are planning to bolster their capital reserves. Let's check in on these markets, of course. The drumbeat towards that CPI print around 1:30 p.m. UK time. The estimates from the Bloomberg survey, 5.1% on the headline basis year on year, coming down then from 6%. But BlackRock's Wei Li telling us markets are wrong to price in cuts at the end of this year. Those will not come through, she and the team at BlackRock think, until at least Q2, possibly Q3 of next year. Across the European benchmark then, still holding on to these gains of a little over 0.1%. Bit of treading water, but still, you are seeing some upside pronounced, particularly in the FTSE 100 and over in Spain. On the Spanish IBEX, gains of 0.6%. Futures in the US pointing to very modest gains there of 0.1%. The Nasdaq futures, by the way, just currently down by 0.1. Euro dollar 109, again there of 0.1%. We continue to watch dollar weakness and whether that is sustained on the back of CPI. Goldman Sachs, by the way, warning that if you get a print above 6% for the month of March on a headline basis year on year, you could see downside of at least 2% for the S&P stateside. The 2-year remains above 4%. Here's the picture on the map then. It's the Spanish IBEX that is a standout across these indexes. And again, the FTSE 100 holding up fairly well, gaining 35 points in the session so far today, up 0.4%. The Spanish IBEX adding 57 points. Every major index in Europe holding on to gains an hour into this trading session as we count down to that all-important inflation print. Stay with us on that topic, though. Investors are counting down, as I say, to that US CPI number. Goldman then, as I mentioned, flagging a potential drop of at least 2%, again, if the year-on-year rate comes in above that previous reading of 6%. Let's bring in Valerie Teitel then, who's been going through the details around how we look at this CPI print out of the US later today and the potential implications, of course, for the Fed. What is in focus for you, Valerie?
Well, let's remember CPI releases have been some of the most volatile days in the last year, so buckle in for today. But we're likely to see some moderation, especially when it comes to headline inflation, dropping from 6% last month to 5.1% is the consensus estimate today. A lot of the market attention is going to be on the core CPI number, especially the month-on-month. That is also estimated to moderate from 0.5% last month to 0.4% today. Now, even within the core CPI basket, traders are going to be looking at the breakdown in between core goods, core services, and the super core metric that Powell loves to talk about, the core services ex-housing component. As you know, we've seen core goods dropping like a stone in the last 12 months, but this disinflation impulse is really yet to impact services. That's those blue bars there in the graph on screen. It has remained quite sticky, and it was only back in February that Powell told us that this services inflation was his main worry. Now, don't forget, we also get the Fed minutes later tonight, and I'm going to be looking very closely on the discussion of what will they weight more. Will they weight this economic data, this CPI data we get today, and the employment data last Friday, or will they perhaps have a discussion on weighting those lending surveys a bit more when it comes to the decision in May? Remember, in the last 2 days alone, we've gotten some pretty substantial lending surveys showing credit availability is tightening when it comes to both small businesses and consumers.
So given all of that, it's probably not a big surprise that you do get divisions, or at least some dispute amongst top Fed officials. Is it changing the market pricing regarding the next move from the Fed?
Look, it hasn't really yet. We're pricing 3 out of 4 chances of a final Fed hike in May to 5.25%. But we heard from Fed's Goolsbee yesterday. He sounded quite dovish. He very much suggested in his Q&A that he wants a pause at the Fed's next meeting in May, urging prudence and patience when it comes to raising interest rates. He wants to be patient and to see the assessment of how much last month's banking turmoil will contribute to tighter lending conditions. This stands a bit at odds from what we've heard from Mester, Bullard, and Williams only yesterday, who have made comments saying that they're not necessarily swayed by the banking crisis when it comes to hiking rates, and paint a bit of a picture that the banking woes are behind us for now. So there is a bit of division, and we might see more hints of that division within the Fed minutes. The May meeting, I still think, is very much a live one. We do get some more important lending surveys before that meeting, especially the Senior Loan Officer Opinion Survey that the Fed runs quarterly. The Fed will have that data before they decide in May.
OK, May is still live. Looking ahead, of course, to the CPI print out later today, and, of course, passing those comments from Fed officials. Valerie Teitel from our markets team, thank you. Now, Fed officials have sounded those divergent notes, as we flagged, about the next policy move. John Williams saying that more work is needed to tame inflation. But Chicago Fed Chief Austin Goolsbee calls for prudence and patience.
Today, what I want us to think about is why I think that at moments of financial stress like this, the right monetary policy is really caution and watchfulness and prudence.
OK, prudence there, the call from Goolsbee. Let's bring in Daniela Antonucci then, Chief Economist at Quintet Private Bank. Daniela, thank you for joining us in the studio. Let's start with your views on inflation. And I want to really zero in on the question marks around the goods part component versus services. Are you seeing any evidence that the impact of rate hikes is starting to be felt on the services component that we know is so important for Jay Powell?
Exactly, very, very important. The short answer is not so much. The shelter or housing component is still very firm. And I think even if it's beginning to slow, and it should slow, what matters is the level. It's very, very elevated. That suggests to me that the Fed should raise interest rates in May, even if there is some degree of tightening in credit conditions. Yes, it should be cautious. Yes, maybe it should pause after that and see the feed-through of interest rate hikes and tighter financial conditions into the real economy. But the job is not done yet, and there is upside risks, I think, to the core number later today.
So what is the time frame that you are looking at regarding services and when you expect that to come down, if indeed the Fed goes for another 25 in May?
Okay, sure. So first of all, I think it's not just one print.
Okay.
Central banks have confirmation biases, and that's the right thing. They want to see that a whole host, a whole range of indicators show that deceleration. Towards year end, and I think we'll have at that point the core measure just above 3.5%, but still rather elevated. It makes sense to pause, I think, after May. Now we are entering that phase of a year and a half after the first rate hikes, when the tightening in financial conditions feed through. So a pause should be warranted after the next rate hikes. But I think the Fed shouldn't cut like markets price in the second half of the year.
OK, so potentially an upside surprise on the CPI print later today. You're expecting maybe inflation around 3.5% by the end of this year, and the Fed should hike and then pause for the rest of the year to allow those hikes to come through and have an impact. When it comes to the headline, do we dismiss that and put that to one side? How concerned should we be about the OPEC plus surprise cut and what that could mean for gasoline prices in the US and the impact on headline inflation? Are you bracing for a tick-up in headline inflation in the months ahead?
Okay, sure. I think we shouldn't dismiss the headline print. Of course, there is this energy disinflation. That's just about what's happening. Food prices, for example, are still very firm. But motor fuels, gasoline prices, yes, they are coming down. There is that feed-through that we are seeing. It is important for inflation expectations. And also it is important for second-round effects. When they feed through, so the Fed feels compelled to respond, and the other way around is true as well. So we shouldn't dismiss it. Of course, headline inflation has been coming down quite a bit from a very high level, just above 9% to 6 and 5.25% or 5.1% now, but that too is still quite elevated.
When it comes to the Eurozone, our team of economists here at Bloomberg suggesting their analysis, at least, that you don't get a sustained turn down in inflation across the Eurozone until possibly September. And then that, to some extent, boxes the ECB in, given its commentary, given its commitment to further hikes to get that inflation print down. What is your assessment of how much more work is needed from the ECB? I
actually think the Eurozone has a worse inflation problem than the US. Core inflation looks stickier. Headline overall inflation is more elevated. The ECB has a hike to a lesser degree. Of course, we need to take into account these bouts of financial instability. These are important air pockets. If that gets worse, the ECB too should moderate, and I think they will, the pace of rate hikes. Eventually should pause as well. But if that doesn't happen, I think there's more upside to policy rates in the Eurozone than in the US.
Does that raise the risk of a policy mistake and misstep from the ECB?
It could increase the risk of a policy mistake. Of course, the policy mistake is when a central bank tightens financial conditions when the cycle is just about to turn. But at the end of the day, there is a degree of disinflation that's very minimal in the Eurozone. The economic data have been holding up a little bit better than expected. And so the ECB looks set to raise rates. I think they will scale back the pace of hikes as well to a quarter point. But there is upside to that.
Okay, what is the quintet view then on how to position for a sustained inflationary environment? What is the opportunity, or at least where is the hedge within that environment?
Okay, so the first point is that generally speaking, we are defensively positioned. We own higher quality bonds, both sovereign and corporate bonds, and more than normal, and a lesser amount of equities. All right, so that's the first bit. Secondly, we recently bought inflation-linked bonds precisely to hedge or to protect against a scenario of stickier than expected inflation. And generally speaking, also, I think we're looking at areas of the world where there isn't much of an inflation problem. One is China. China is reopening. It's today where we were in the West a year and a half, 2 years ago. And so we have increased our equity exposure to Asia Pacific as a whole, because China is a different point in the cycle.
Okay, really interesting. Defensively positioned, a little bit of upside possibly coming through from Asian equities powered by China, and maybe adding, in terms of inflation-linked bonds, US tips in favour. From Daniele Antonucci, Anton Ucci, I should apologise for the mispronouncing of your surname there, Chief Economist at Quintet Private Bank. Really important and insightful comments there. As we lead up, of course, that print out of the US and the views on the ECB, how to position with a sustained inflationary environment. Coming up, the biggest US banks planning to set aside about $100 million each to bolster reserves. We're going to impact on the story, the details, what it could mean for the US banking space, the price that's being paid to support those smaller lenders. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Let's get to the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Hi, Tom. The Swiss Parliament's lower house has symbolically voted against approving 109 billion francs in government guarantees for the UBS Credit Suisse deal. While lawmakers can do little to derail the takeover, they're still likely to push the government to overhaul too big to fail rules and pursue legal action against Credit Suisse's management. Now, UK police say they are investigating the Confederation or British industry following allegations of sexual harassment and rape among staff. The City of London police say they approached the CBI, that's Britain's biggest lobby group, after the Guardian newspaper reported allegations made by more than a dozen women who have worked at the organisation. The CBI says it's liaising with the police and would cooperate fully with any inquiries. French Finance Minister Bruno Le Maire says Europe mustn't be pushed around due to the rivalry between the US and China. Speaking to Europe One Radio, he said being a US ally doesn't mean that France should be against Beijing. His comments come after President Emmanuel Macron's visit to China, and that was last week. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Tom.
Leanne, thank you very much indeed. Now, the biggest US banks are planning to bolster their reserves in a move tied to their unusual effort to shore up ailing lender First Republic Bank last month. Let's get more with our finance reporter, Tom Metcalf. Tom, how big is this reserve boost? What should we read into it?
Yeah, so in terms of size, we understand it's about $100 million for, say, the biggest banks involved in this move to leave deposits with First Republic. So look, you know, for a JP Morgan, a Citigroup, $100 million provision isn't going to massively change their earnings. But what I think it's interesting is basically it shows that, you know, this move was not without cost. there is some risk associated with leaving deposits with the First Republic. So, interesting to hear them making this change.
And the fate of First Republic is still somewhat unknown as well, isn't it? When it comes to the earnings picture, kicking off Friday, banks, what are you looking at?
Yeah, well, so for the big ones, it's like, how are the investment bankers doing, how are the traders doing? Of course, what are they looking at net interest margin? I mean, I think the outlook will be really interesting. What are they saying? Is there sort of more economic turmoil ahead? Do they feel the bank crisis has passed, etc.? And then, normally we don't pay as much attention, but the regional US banks are probably going to be in the spotlight, given stuff like First Republic, given SVB. So we'll have a lot of coverage on them as well.
As we switch back the focus to UBS and Credit Suisse, the US, or the Swiss Parliament, I should say, coming in with some decision-making. How consequential is it? What does it say about the body politic of Switzerland right now when it comes to that deal? I
think it shows the divisions, right? So it's largely symbolic. This deal is going through whatever, but it's pretty embarrassing that you've got the lower house of Parliament saying we would not have approved this deal. So look, what's happening right now, this session is continuing, and I think everyone in Switzerland's sort of establishment is trying to find a way to get this lower house on board. So, perhaps there's sort of some kind of, offering they can give to them to make them sort of a bit more comfortable with the offering. So at least symbolically, everyone's on the same page. OK, symbolic for now rather than substantial, but we continue to keep across that session that continues, as you say, in Switzerland. Thank you for breaking down what is happening across the US banking space and, of course, in Switzerland as well. Bloomberg's finance reporter Tom Metcalf. Coming up, US Defense Secretary Lloyd Austin says Washington will not stop until it tracks down how classified documents on Ukraine were leaked. We've got the details next. This is Bloomberg.
I would also caution at this point that we not draw too many conclusions. This could be an influence operation by somebody, we don't know who. And once you get into the world of counterintelligence, it makes being in a hall of mirrors look easy. It's very complicated.
Former US National Security Advisor John Bolton there on the US security leak. And US Defense Secretary Lloyd Austin says Washington will not stop until it tracks down how a trove of classified documents appeared online. For the details, let's bring in our senior reporter for international affairs, Mark Champion. Mark, what is the latest then on this US intelligence leak?
Right, so we still don't know much about how these documents got into the public domain, but increasingly we know more about the substance of these various documents, with the proviso that any of them could have been doctored. We simply don't know. We know that in principle, the Pentagon is acknowledging that these are the real deal. But they may have been doctored afterwards because they've been all around on the internet. So, in terms of substance, what's kind of new is that, the Washington Post has reported that Egypt was planning to produce 40,000 rockets for Russia, which would be a huge embarrassment for the US and a big problem for their relationship. The US has said that they're not aware of any of those actually being delivered or made. And the Egyptians have said on local media that it's false. Nevertheless, that's out there. Equally surprising is a document released from, reported by Reuters, where they are saying that Serbia has actually provided weapons to the Ukrainians. Serbia is a big ally of Russia and has refused to join Western sanctions. So that is also a big surprise, potentially a problem politically for the Serbian regime. And then after that, we also had another document which suggested that the Hungarian Prime Minister, Viktor Orban, had said that he saw the US as among the top 3 threats and opponents to his party, Fidesz. So all those things coming out on top of other stuff that we already saw.
Really fascinating, again, if verified. The other reports coming through that there are British and US special forces on the ground in Ukraine. How surprising is that?
Right.
And what does that do to the Russian view that they are fighting NATO, as they have espoused?
Right. Well, they will certainly use this to make their case, but they've been arguing that from day one almost. But you know, in terms of the substance, not a huge surprise. We knew that Western troops and special forces have been involved in training the Ukrainians for some time. The fact that there are 50, according to this report, UK special forces in Ukraine working with the Ukrainians, that is a pretty big number in terms of special forces. You know, in terms of the UK special forces, that's quite a big number. So they're obviously fairly involved. What they're doing exactly, we can't say. You know, that's the US and France had only about 15, 14 respectively. So that's quite a big number for the UK and won't help an already very problematic relationship between the UK and Russia.
OK, Mark Champion, thank you very much indeed on the latest when it comes to this intelligence leak, our senior reporter for international affairs. Coming up, political chaos and a crippling energy crisis. Is South Africa still investable? We have an important interview coming up. This is Bloomberg. US headline and core CPI readings will be pored over for clues on the course of Fed interest rates. Equity and Treasury moves, they're muted before that report. Hike versus hold. Fed officials signal divisions over their next policy decision. Plus, sources say big US lenders that shored up First Republic Bank last month are now planning to bolster their capital reserves. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Let's switch focus now to what is happening in one of the key emerging markets. Rolling blackouts, record high unemployment and political chaos, crippling South Africa's economy and arguably its global reputation, at least for now. So is the country still investable? Let's bring in the CEO of one of the nation's leading banks, Richard Wainwright from Investec Bank, South Africa. Richard, good morning. Thank you for joining us out of our bureau there. Let's start with that question then. The crisis on the energy front, the power cuts, the load shedding, of course, the political scandals and the downgrades to growth. Is South Africa still a place where investors should be putting their cash to work?
Good morning, Tom, and good morning to your viewers. Thank you for having me here. Yes, the challenges that you've just mentioned are very acute and very serious. It does make South Africa an incredibly difficult investment environment now, both for international capital and, in fact, domestic capital. The energy crisis, and I'm glad you referred to it as an energy crisis, we've had around for some time now. 14 years of load shedding, which doesn't seem to be ending and, in fact, is intensifying it. We expect it to intensify over the next 2 years and then slowly start to shift down in the following 2 years, as the private sector, in fact, starts to take up the capacity that Eskom has lost. So a very challenging environment, both external factors as well as domestic factors, which you've just mentioned. So a very difficult investment environment at the moment.
Yeah, a challenging environment, and that's remarkable in terms of the time frame. 14 years of load shedding, and your forecast that we're going to get another 2 years of this. What is the impact on your business, Richard?
Yeah. Well, for us, as you said earlier, quite a sizable domestic player that's very niched, we've done particularly well. So coming out of load shedding, coming out of the global crisis, COVID crisis, the domestic banks, including us, have done reasonably well as we've recovered from that. But going forward, we think that the macro environment is going to be very difficult. As Investec, we're a niche player. And we look to try and extract growth even in a difficult macro environment. But in aggregate, it's going to be a very challenging environment for all the banks here to eke out some real growth in this economy.
What actions on the energy crisis, on the load shedding, what are the specific actions that you would want to see from your government to address that challenge?
Well, I think what the government has done to date, which is basically enhance the private sector's capacity to invest in power generation, is now, the caps have been lifted, it's now unlimited. So over the next 2 to 3 years, we are going to see a large amount of domestic private investment come into the space, which will ease the burden on Eskom. My sense is that over the next 10 years, if I can stretch it out that far, is that Eskom as a generator in this domestic environment will become quite a small player. What government does need to do, however, is increase the capacity on the grid. The transmission grid needs, in our estimation, approximately 50 billion rands worth of investment to increase its capacity. That will still be a limiting factor. We think that the private sector will, as I said, invest in the generation side. Most of the obstacles for that have been lifted now. The remaining obstacle will be the size of the transmission grid.
What is your personal assessment of the ability for the government, your level of confidence that the government can actually make these moves and address this challenge?
Look, the current government has been very, very slow in policy reforms over the last 5 years. We expected the current president, when he came into the presidency, to accelerate reforms. Unfortunately, we've not seen that. The reforms on power generation side have been slow, but we think sufficient now to attract the domestic investment, in fact, some international investment as well. But the restructure of Eskom itself, the correction of Eskom needs to be accelerated. Splitting Eskom into its 3 parts needs to be accelerated as well. Unfortunately, we've got a general election next year, so significant policy changes are going to be difficult. So our baseline expectation is that we're not going to see massive policy shifts, which we need. We need the structural reform to attract the international investment. I don't think anything's going to happen until after the elections next year.
OK, and I want to get on that. Before I do, Richard, what is your sense when you speak to those international investors as to their view on South Africa? Is it becoming crystallised in terms of their negative response to the lack of appropriate policy action in South Africa, the concerns, the challenges, or is this a short-term concern for those investors?
Look, I do think it's relatively short-term. South Africa does have a lot of positive attributes that can attract international capital for an emerging market. We have a very sophisticated financial sector, for example, a well-established legal system, strong and deep capital markets. So all those things that the private sector needs to have in place are here. And that's not going to go away. So that kind of infrastructure, financial infrastructure, regulatory infrastructure is all in place to attract the capital, both domestic and international. However, you can imagine with the amount of load shedding, and I see our minister, our newly appointed Minister of Energy, has said that we could be expecting load shedding stage 8 to 10. Apparently, he referred to that in a speech yesterday. That is very, very negative for us. So until we get the load shedding, then the energy crisis sorted out, we're not expecting a significant inflow of capital, as you can well imagine.
OK, and presumably that load shedding question and issue will be front and centre when it comes to those elections next year that you flagged, the national elections in South Africa. What is the political risk there, do you think, Richard? How do you see that unfolding?
Look, I think there's probably the highest level of uncertainty politically that we've had since 1994. There's a lot of speculation that the ANC will lose its control at 50% and could go below 50%. There's a lot of uncertainty and speculation around who they will go into alliance with. When we look at the domestic side on local authorities, it does appear that they are siding in certain instances with the EFF. That will be very negative for international investors and domestic investors. So I think the level of uncertainty on the politics will, again, make it very difficult to currently attract a significant investment, both internationally and domestically.
And Richard, if we step back from the uncertainty and the challenges in South Africa and look at the uncertainties in the global banking space, particularly, of course, in the US in recent weeks and months, and, of course, UBS, Credit Suisse in Europe, what is your assessment of where we stand in terms of that banking crisis? Are you confident that we're through the worst of it?
Yes, I am confident we're through the worst of it. I don't know even personally if I would refer to it as a banking crisis. You know, we've had 2 banks in the US. Yes, I know some of the larger banks have stepped in to assist in First Republic. There's certainly not been a spillover here into South Africa. Our domestic banking system is very highly regarded and well capitalized. I think when I look across into Europe, the Credit Suisse situation was pretty well known. I think it had been in a gradual decline for 3 years. I think it all seemed to happen at the same time. So I wouldn't call it a global banking crisis as such. We are obviously very, very acutely aware of the spillover and systemic impact that runs on banks can have. Having read the press recently and referred to some of the comments made by the CEO of Citibank and others around how this could be with digitization of banks and the ability of depositors to withdraw money digitally and electronically, does make the system slightly different to what it perhaps was in the past. But from my sense is that the regulators are pretty much on top of what's happening. I think the large systemic banks seem to be well capitalized, in good shape, and their stress scenarios that the regulators have done, I think, are probably appropriate.
Okay, Richard Wainwright, CEO of Investec Bank, South Africa. Really appreciate your insights on the broader global banking space, the challenges, the hurdles, of course, facing investors in South Africa, and of course, particularly around the energy crisis and political risk. Really appreciate those insights. Right, coming up later today, we're going to be at the IMF World Bank Spring Meetings. We're going to be joined by the Reserve Bank Governor of South Africa, so the conversations around that economy continue. That interview is at 6:40 p.m. UK time. Meanwhile, a line crossing the terminal, the Swiss upper house voting for tweaked UBS guarantees. We know that yesterday the lower house voted against those guarantees, largely, as our team have been describing, symbolic. But we keep across these lines for you in terms of the political reaction to that UBS Credit Suisse mega tie-up. Coming up, President Biden has touched down in Belfast as he kicks off his tour to mark the 25th anniversary of the Good Friday Agreement. What are the key things to watch? We'll discuss that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, President Biden's trip to Ireland and Northern Ireland begins today. His first stop will be in Belfast, where he will be meeting with UK Prime Minister Rishi Sunak. After that, he'll be heading to the Republic of Ireland to visit Dublin and the counties of his ancestors. For more, let's bring in Bloomberg's Dublin Bureau Chief, Morwenna Cunningham. Morwenna, what is on Biden's schedule today and later this week? What are you and the team going to be watching for?
Well, yes, this morning he is in Belfast. He's going to be meeting with UK Prime Minister Rishi Sunak. Then he's going to be actually meeting with some of the party leaders of the Northern Irish parties very briefly before he addresses an audience at the University of Ulster, where there's hoping there'll be some discussion of trade in Northern Ireland, as well as really delivering the message about supporting the achievements of the Good Friday Agreement, which ended 30 years of sectarian violence 25 years ago, and also his commitment to supporting continuing peace on the island of Ireland. And that leads up to his trip. He's arriving in Dublin this afternoon. He's then going to be visiting the counties of Louth, and he's going up to Dundalk, where he has ancestry. He'll be doing a bit of a walkabout there before returning to Dublin tonight. And then tomorrow is really the big day here, where he will be meeting with Irish Prime Minister, or Taoiseach, Leo Varadkar. They'll be discussing shared matters of economic interest, the war in Ukraine, and of course Northern Ireland as well. And then he'll also be addressing the Irish Parliament later in the day. And on Friday, he's heading to County Mayo, where he has a lot of ancestry, and he will be delivering a big speech there on Friday night as well.
Morwenna, do we expect anything substantial, anything concrete on the policy front from Biden?
I think it will be difficult to know exactly what they're going to discuss. There are obviously a lot of issues up in the air, not least we've recently had the revelation that information is being leaked from Pentagon papers. So that is something that's likely to be on the agenda as he discusses matters with his allies. In terms of US policy, it comes down to the economic collaboration, Ukraine, and bilateral agreements. But I don't think we're expecting any major policy announcements directly.
OK, Morwenna Coniam, Bloomberg's Dublin Bureau Chief, thank you ahead of that visit by the US President to the island of Ireland. Coming up later today, we're going to be at the IMF World Bank spring meetings. We're going to be speaking to UK Chancellor Jeremy Hunt. That's at 9:40 p.m. UK time, 4:40 p.m. in New York. We'll be covering all things UK every week, of course, on Thursdays at 9:30 a.m. London time in our half-hour special. Let's get to the Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Tom, good morning. Elon Musk says that most of the advertisers who fled Twitter after he bought the company have now returned. Musk spoke in a rambling Twitter Spaces interview with the BBC that actually attracted more than 3 million listeners. The Twitter and Tesla boss also turned the tables on his interviewer, questioning the BBC over hate speech and COVID disinformation. Now, for the first time since 2018, Boeing has taken the jet delivery crown from arch-rival Airbus. The US company says it delivered 130 aircraft in the first quarter, up more than a third from a year ago. Boeing continued to build on its cash cow 737s at a steady pace and released already built 787 Dreamliners and MAX jets from storage. Airbus delivered 127 planes over the quarter. Now, that was fewer than a year ago. EY has scrapped its planned breakup, exposing the shortcomings of the partnership model in professional services. The Big Four accounting firm intended to spin off its consultancy business and much of its tax practice into a standalone public company. Leaders of the $45 billion firm told partners yesterday that an eventual split was indeed possible, but that more time and investment was necessary to make that happen. And a pair of Michael Jordan's trainers from his famous Last Dance season has sold for $2.2 million at a Sotheby's auction. That makes him the most expensive sneakers known to have sold, exceeding the previous record of $1.8 million for a pair of Nike Air Yeezy shoes. Jordan wore them during Game 2 of the 1998 NBA Finals. And coming up, we've got the countdown to US CPI data for March. That's due out later today. And what it could mean for the Fed next. This is Bloomberg.
It's facing the highest inflation in the European Union at around 25% year on year. And Hungary also has the highest effective central bank policy rate in the bloc at 18%. The government in Budapest has been calling for interest rate cuts to try to stimulate an economy already in recession. But monetary policymakers have been pushing back, citing the need to tackle inflation. The challenges are political and geopolitical as well as economic. The Central European country depends on energy imports from Russia and is facing a high bill. That's amid a dramatic weakening of the country's currency, the forint, last year. There's also the issue of EU funding. Prime Minister Viktor Orban's government is in talks with the EU to try to access 37 billion euros of funds. Those are currently frozen over alleged violations of the EU's fundamental rights and perceived politicization of the court system. But in the meantime, policymakers are left with a tricky tug-of-war as the next policy decision looms later this month on April 25th.
That was Bloomberg's Max Ramsey, and we did get Hungary's inflation data for March earlier this morning. It eased slightly from February, but still came in hotter than economists were expecting at 25.2%. That's year on year. Now, we are, of course, counting down to US CPI data for March, due out later today. Let's bring in Jamie Rush then from Bloomberg Economics on what to expect. Jamie, what are you watching for?
Well, we're expecting, like the rest of the street, that inflation is going to drop to 5.1% on the headline measure. I think probably more important is the core inflation reading, and there I think the news is less good, rising slightly to 5.6% year over year. It's not what the Fed wants to see. Clearly, they're going to have a hiking bias until they see those numbers start to edge down. When it comes to the euro area, you made the call, or at least one of our guests, I should say, made the call earlier on the programme, getting the two of you muddled up, that actually the inflation picture out of Europe is worse than that in the US. Is that a view you align with? No, I don't agree. So I think core inflation is going to look bad over the next few months. There are statistical reasons why that's the case. It's not necessarily something genuine. But we are going to see core inflation, headline inflation falling sharply through the second half of the year. So I don't think we have a serious problem. We don't have massive wage gains like we've seen in the US and even in the UK. So I think the ECB's problem is actually faces less of a trade-off than, say, the Fed or the Bank of England. How many more hikes are you expecting from the ECB then, given that? Well, I think they're going to be forced to do something over the next two meetings, I think. So another 25 basis points in May and June. At that point, they'll also probably accelerate the pace of quantitative tightening, and that would be a natural point, I think, to take a pause. Risk is that they just keep going until September and they actually see core inflation drop. I'm bringing it back to the Fed because you have this divergence then you're expecting between the ECB and the Fed. You think they go again, the Fed, in May, and then they pause. But the markets continue to bet on cuts towards the end of this year. They're setting themselves up for a fall. Yes, our US team's of the view that core inflation is just going to be very sticky. Even if you see growth start to even turn negative in the second half of the year, it's not going to make a dent in underlying cost pressure until later on. So we don't have any cuts from the Fed in our forecast until early 2024. I guess the wild card is financial stability. If things flare up again, that could bring things closer. On the headline basis, there's a temptation to put it to one side because of that focus on core, because of that focus on services. But the headline is important in terms of psychology, the psychology of the consumer. Have consumers started to walk away from expectations that inflation will remain stubbornly high? Are we starting to see the consumer change on that? I mean, we haven't seen it too much in the US yet. I mean, I think 1 and 3 year ahead inflation expectations are still pretty high. But you're right, though. I mean, the reason that central banks were so attuned to the headline rate when this all started is because they're worried about the risk to inflation expectations that headline inflation causes. That, at least, is going to go away over the coming 6 months. So, I mean, there's small mercies there. OK, small mercies. We're looking for those small mercies. Jamie Rush bringing them to us live on Bloomberg, of course. Thank you from our Bloomberg Economics team with a preview of US CPI, all important for markets today, of course. Bloomberg Surveillance Early Edition continues in the next hour. None other than Matt Miller in New York and Anna Edwards in London. As we check in on the markets, European equities gaining 0.2%. Futures in the US now turning higher by about 0.1%. Range bound on the Nasdaq futures. The US 2-year remains above 4%. This is Bloomberg.
Hopes that they can continue to hike rates while also supporting the financial system through their tools for financial stability, which includes macro-pru, regulation, supervision.
They still want to be sure that inflation is moving lower in a sustained fashion.
We don't know exactly how long it's going to take for all that monetary tightening they did last year to work its way into the economy. The Fed shouldn't just be on autopilot and keep hiking.
This is not going to be the immaculate deflation story that we had at the very start of Q1.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York and 5 p.m. in Hong Kong. Our top stories today. The Fed versus inflation. Officials at the central bank are signaling a divide over whether to raise interest rates again. We will get the latest numbers on consumer prices in a few hours' time. The big banks that shored up First Republic last month are now planning to bolster their own reserves. The largest contributors to the $30 billion in deposits are putting aside $100 million each. And multi-billion-dollar offers on the table in the commodities sector. Both Newmont and Glencore are hoping to close deals. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, we are waiting for that inflation print once again. I know that you are excited.
I am pumped up, yes, because look, yesterday we had one of the most boring days, just looking at the indexes that we've had in months, right? We were trading on the S&P 500 in just a 0.5% band. That's the littlest movement that we've seen since November in the benchmark index. However, on CPI days over the past year, we've seen the S&P move up or down an average of 1.9%. That's a pretty big move and more than double what it had been in the previous 12 months. So wait for the number coming out at 8:30 a.m. New York time, and then just watch the markets. Right now, we're just up 0.1% on futures, but I'm pretty excited for this release, as I think is everyone else. Take a look at the lack of movement everywhere else, right? I could have picked any assets, but the 10-year yield still at 343, 344. NYMEX crude still at $81 a barrel, 81.65 right now. Bitcoin still at 30,000. Gold still at 2,000. Everything is just stuck here, I guess, waiting for CPI or waiting for Godot. I don't think I ever saw that play. Let's take a look at what's going on in Asia. Right now, the MSCI Asia Pacific is completely unchanged. The Hang Seng down, the Nikkei up, and the dollar gaining a little bit of ground against the yen. Really just in wait and watch mode. And what's Europe looking like?
Yeah, absolutely. Wait and watch mode. That's certainly how things feel here in Europe. Really not moving anywhere very fast. We still have plenty to talk about in terms of those big global themes, but the market's not really reflecting that sort of narrative excitement today. We're up by 0.6% on the FTSE 100, which is more than we were half an hour ago. But certainly we are seeing modest gains across Europe as we wait for that print. The IBEX down in Spain, catching up from some of the losses that we saw this time yesterday on the Spanish market. Technology in focus. That's one of the sectors that maybe underperforms a little bit today. Prosus, it has a stake in Tencent over in Asia, and they've been reducing their stake gradually in that business. That's weighed on Tencent. There's been speculation maybe Prosus will start selling the stake a little more quickly. That's quite a heavyweight in the Dutch market, and that weighs on the technology sector. Volvo is up by 7.7%. This is not the cars, this is the truck and the bus manufacturer, up by this amount, 7.7% as a result of the numbers coming. Right, there we go. As a result of thank you very much for translating into English. As a result of the better than expected numbers coming through from Volvo early hours, well, last night. So that's certainly one that we're watching. Supply chain issues, seemingly a thing of 2020 and 2021 and not of 2023. Here's a couple of currencies. I put the euro dollar in here because we're watching that with CPI in focus. I also put in the Hungarian forint. It is one of those days where we cast our eyes a little further to some of the assets that may or may not be moving, and not a great deal of movement in this, despite the fact that we've got a really interesting inflation story here, coming in above 25% for the Hungarian economy, the highest in the European Union, rates the highest in the European Union. But we had seen for the second month a little bit of moderation. It seems maybe this cross also waiting for the CPI print.
A little bit of moderation, but I know you spoke with Wei Li this morning from BlackRock. They expect inflation to be sticky. The ECB expects inflation to be sticky. So there's real concern about prices once again. Speaking of that, Fed officials are signaling there's a divide over whether to raise rates again. New York Fed President John Williams says there's still more work to do to bring down inflation, but Chicago Fed President Austin Goolsbee became the first official to suggest that policymakers may need to hold off on further hikes for now.
Today, what I want us to think about is why I think that at moments of financial stress like this, the right monetary policy is really caution and watchfulness and prudence.
Valerie Teitel, Bloomberg Markets reporter, joins us now for more on this. So Fed officials have spoken publicly in the past couple of weeks, sounding pretty similar in their message. But now we have a new guy, not really new, right? He ran the Council of Economic Advisors under Obama just after the financial crisis. But a new voice, let's say, on the Fed.
Yeah, the new voice, Goolsbee, maybe he'll start sounding a bit more like Brainerd. He very much suggested in his speech yesterday that he wants a Fed pause in May. He said we need to be patient in the assessment of just how much last month's banking turmoil will contribute to tighter lending conditions. Now, that stands at a bit of a contrast to the other Fed members that we've heard from, namely Mester, Bullard, and Williams, who have all said that they have not been swayed yet by the banking crisis crisis when it comes to hiking rates. Williams just yesterday told the press that one more hike is seen as reasonable. And then we also heard from Harker saying he wants to hold rates above 5%. That suggests another hike is coming in the May meeting. Now, they have said also differing things when it comes to credit conditions tightening. Williams 2 days ago said he hadn't seen any clear signs of credit conditions tightening. Well, we got a small business survey out yesterday, and boy, it showed that credit availability to small businesses has contracted in March, and it contracted quite substantially. Compare that level to the levels that we reached during the credit crunch of 2008, 2009, and you can just see how sharp this drop was. Now, you also have to combine this with the survey data we got from consumers on Monday, also painting the same picture that March saw a big contraction when it comes to credit availability, both for consumers and for small businesses. We do also get those Fed minutes tonight. I'm going to be watching very closely if there is a discussion on what they will weight more in the May meeting. Will it be the survey data on credit conditions, on lending standards, or will it be the harder economic data like the CPI we get today?
Yeah, certainly worth watching then, Valerie. And with that CPI in mind, what are we expecting from today's US CPI print? Really fascinating to see how this has morphed from a story that was about goods and supply chain disruption to one that is almost entirely about, well, food and mostly services.
Yeah, those sticky core services are still keeping the Fed up at night. The CPI, the headline today, is expected to moderate quite substantially from 6% previously to 5.1% today. That's the Bloomberg consensus estimate. A lot of the attention, like you said, is going to be on the core month-on-month number. It's also expected to moderate, but not by much, falling from 0.5% last month to 0.4% today. Now, a lot of the attention, as I said, is going to be even now on the breakdown of those core inflation when it comes to core goods, which we know has been dropping off like a stone in the last 12 months, versus the more sticky component of core services. Remember, Anna, it was only back in February that Powell told us in the press conference that core services was his main worry. Has the Fed hiked enough in order to bring core services back to target? It's a component of inflation that is less sensitive to interest rates, and it makes up a very substantial portion of the CPI basket. Almost 75% of the core CPI basket is in services.
All right, Valerie, thanks so much. Valerie Teitel there, painting the picture that we need to be watching this morning. I'm really focused on the core number as well. Of course, I prefer the annualized number, so watching for 5.6 or better. Now, the biggest U.S. banks are planning to bolster reserves in a move tied to their unusual effort to shore up ailing lender First Republic Bank last month. Let's get to Bloomberg Finance editor Michael Moore. What's driving these reserves from the big banks? And we should point out, really not big reserves compared to the amount that they put on deposit.
Yeah, you're talking 2% of the total, but it is a recognition that this is not a riskless asset, that putting this money into First Republic does carry some risk. And, it could be a meaningful move to the quarter's reserves. Bank of America last quarter had $1 billion in total reserves. So adding $100 million there does move the needle to a quarter to quarter. But assuming that this plan works and buys First Republic time to sort itself out, then they wouldn't actually lose anything, and they could take the provisions back. But it is an acknowledgement on the accounting side that there is some risk at play here.
And let's pivot from US banking then, Michael, to European banking, and particularly the case in Switzerland, the ongoing conversations within the Swiss parliament about what just happened with UBS and Credit Suisse. Now, tell us what's happening here, because we've seen some objections being raised in the lower house to the deal, but this is really very symbolic rather than actually standing in the way of the deal being done.
Yeah, it's a bit of a protest vote showing that the lawmakers were not happy with how this was arranged, how it was set up. So you could see some tweaks to some of the government guarantees perhaps in the future, or changing the rules. But yeah, it's not a vote on the deal. The deal has been set up and approved by the Finance Council of the government. So it will go ahead, but it is an election year in Switzerland, so you are seeing a bit of discussion over how this was handled.
Maybe a little bit political. Michael, thanks so much. Michael Moore there talking to us about the banking news. Let's get now to M&A because deal making in mining is heating up. U.S. gold giant Newmont has sweetened its record bid for Australian rival Newcrest. We told you about that yesterday. If successful, it'll be the world's largest gold acquisition. Meanwhile, Swiss commodities giant Glencore is making an effort to buy Canada's Teck more appealing. They're trying to help people reduce exposure to coal, dirty coal, if that's what they're worried about. Will Kennedy, Bloomberg senior executive editor for energy and commodities, joins us now. So, Will, mining M&A has been pretty quiet for years. Why are we suddenly seeing these big deals?
That's right, Matt. There haven't been many big deals for the last 10 years. Investors have been very cautious about big M&A. But that does seem to be changing right now. I think there are two key drivers. One is copper. Clearly, the pursuit of Teck by Glencore is driven by their desire to get their hands on Teck's copper mines. Copper is forecast to be in a substantial deficit in the coming years. And when we interviewed CEO of Glencore, Gary Nagle, last month, he said that he expects copper to go above $10,000 and stay there. So that's the bet he's making. Copper is absolutely crucial to the energy transition and the rise of electrification. The other thing that's going on here is that people's balance sheets are strong. If you look at Glencore, for example, it's made huge profits over the last year, driven by its coal business, and it has very little debt at all. It's got the capacity to do deals, and it sees this as the right play. And going back to Newmont-Newcrest, copper is also a driver there. It's primarily a gold mining company, as you say, but Newcrest wants half its production to come from copper in coming years. So that's also in the background with the gold deal.
So it sounds from what you're saying then, Will, that you think that there could be more of this, given balance sheets as strong as you point out, and there could be reasons to go about looking for these kinds of assets globally. On the Glencore and Teck Resources deal, Matt was mentioning in the link there that there might be some concerns about certain types of coal being more dirty, and maybe this is going to be something that stands in the way of these deals. They're not all done deals just yet.
No, they're not, and especially the Glencore Teck deal, I mean, which hangs on what the Keevil family, which own a small part of Teck, but they own these super voting shares, so they have to go for the deal, and that's not clear they want. So that deal is very much in the balance. But what's interesting about it is that it will, if it goes ahead, you will get a metals company and you will get a coal company. And those people who want to stay in coal can stay in coal, and those people who want to be in the metals company can. And the thing that Glencore did yesterday was give people the option to take cash rather than shares in the coal company. So it provides options for people who are happy to be in coal and those more ESG investors who aren't.
And I think that makes it creative and even more interesting. Will, thanks very much for joining us. Will Kennedy there talking us through some of the M&A in mining. Let's take a look at some of the pre-market movers because M&A stocks plays well into that. Emerson Electric is in advanced talks to acquire National Instruments after the long pursuit of the maker of measurement systems. According to people familiar, you may not have heard of any of these companies, but Emerson Electric is a $60 billion company. National Instruments is a $7 billion company. And Emerson beat out Fortive so far, at least, talking about paying $60 a share for National Instruments. Fortive is a $25 billion company. So these are big companies all competing for National Instruments, which makes hardware and software that scientists use. I think a very interesting M&A story there. Also, Bed Bath & Beyond shares are rising in pre-market trading after the troubled retailer raised almost $50 million for the sale of 100 million shares. It's looking to raise cash to avert bankruptcy, just to keep the lights on, really. And then Carnival, the cruise line, plans to pay down debt to avoid borrowing at these high rates. That, according to the chief financial officer, David Bernstein. The Miami-based business had about $8 billion of liquidity. That's enough to pay off roughly $4.5 billion of debt due coming later this year and in 2024. This, according to an interview that Bernstein had with Bloomberg yesterday. Anna?
Coming up on the program then, Matt, we will talk about flows. We will speak with Vice President of Spider ETFs at State Street Global Advisors. We'll get the perspective on where money is flowing into and out of right now. That'll be an interesting conversation. What about EM in a world where the US slows down? We'll also talk to Silvia Ardagna, Chief European Economist at Barclays. She'll be giving us a Europe view, but also the view on CPI and the data due out of the US later and what that means for the Fed. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller here in New York with Anna Edwards over in London. I'm looking at a really interesting chart. For those of you on radio, listening on radio, I'll walk you through it. Basically, it's the gold to oil ratio. It spiked up during the beginning of the pandemic as people freaked out, obviously, and stopped driving. Now that we're back in our cars, it's come back to a normal level. I think the average is around 16 or 17. That's gold to oil. But now we're spiking back up again to about 25. Joining us to talk about why is Dana El-Baltaji, Bloomberg Managing Editor for Credit. So, Dana, why are we seeing the move in this ratio? What does this ratio actually mean to us?
This is a really good yardstick to just kind of explain how people feel about risk right now. I think what we're seeing is a lot of investors looking for the safest of assets out there because what's coming is economic pain. And I think that seems to be the consensus. It's not just in gold and oil. We're seeing that in the credit world. Today, for instance, we've got about 8 issuers in the market. Almost all of them are selling the safest of the safe bonds. And that's because there's absolutely no appetite out there for risk whatsoever. So that is a really interesting warning sign that my colleague Van Ram has put together.
Okay, so that's an interesting warning sign, Dana. And yesterday we spoke to one of your colleagues around the credit markets, and you've got some other insights. We're learning day by day what investor appetite looks like for different types of credit, of course. Where do we stand in terms of demand for risky loans at this point, and why do we see the dynamics that we do?
So what's really interesting within the risky loan market is because people are seeing an end to the hiking cycle, all of a sudden there is demand out there for risky loans because these are floating rate assets. So there is the financing buyout that was used for DSM, which was basically sold to a bunch of investors that genuinely wanted this stuff, and that's because they think interest rates will likely fall. That is basically a sign that recession might be coming, because the assumption is that if central banks have to worry about the economy, then they're not going to continue hiking rates even though inflation is high.
And that could be good for those businesses looking to raise money right now. Diana, thank you very much. Bloomberg's Dana El-Baltaji. For more market analysis on credit markets and much beyond, Markets Live Go is the function to use on your Bloomberg terminal. That's where you'll find the blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, keeping you up to date with news from around the world, here's the first word. President Biden is in Belfast, Northern Ireland, where he'll mark the 25th anniversary of the Good Friday Agreement. That deal ended decades of violence between Catholics and Protestants. The president's also meeting today with the UK Prime Minister Rishi Sunak. Donald Trump wants a 4-week delay in the start of a civil trial over his alleged rape of the author Jean Carroll. His lawyer says a cooling-off period is necessary following his indictment in the case of hush money payments. The trial in the Carroll case is due to start April 25th. Walmart is cutting the number of stores in Chicago in half, from 8 to 4. The nation's largest retailer says it hasn't made money in its 17 years in the city. Walmart faces tough opposition in Chicago from Target, Albertsons, and Aldi. It says that crime and theft, though, were not leading drivers of the decision. And Elon Musk says that most of the advertisers who fled Twitter after he bought the company have returned. Musk spoke in a long Twitter Spaces interview with the BBC that attracted more than 3 million listeners. He also defended firing thousands of workers, and Musk turned the tables on his interviewer, questioning the BBC over hate speech and COVID disinformation. So, interesting? Is it interesting? I guess.
Well, it was a wide-ranging conversation in which, Matt, he announced that Twitter has a new CEO and that CEO is his dog. So there you go. It ranged far and wide. Coming up on the programme, we'll talk to Vipul Faujdar, who joins us, Vice President of Spider ETFs at State Street Global Advisors. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed versus inflation. Officials at the central bank are signalling a divide over whether to raise interest rates again. We'll get the latest numbers on consumer prices in a few hours' time. The big banks that shored up First Republic last month are now planning to bolster their own reserves. The largest contributors to the $30 billion in deposits are putting aside $100 million each. And multi-billion-dollar offers on the table in the commodities sector. Both Newmont and Glencore are hoping to close deals. I'm Anna Edwards in London with Matt Miller in New York. And Matt, we're really focused on that CPI print due out later today. Interesting what that means for the Fed and the hiking cycle, but also talking to some of our colleagues on the Markets Live blog earlier on, they draw attention to whether we'll get any clues, any softness in inflation. Could that add to bets on rate cuts later on in the year? And maybe that's where some of the excitement could be.
Yeah, I guess we'll be turning to Warp right after we look at EcoGo. Right now, we're not seeing a heck of a lot of movement in markets as investors sit on their hands waiting for that print coming out at 8:30 a.m. Wall Street time. S&P futures are up about 0.1%. You have seen a ton of volatility around CPI prints over the past year. In fact, the S&P 500 has moved up or down an average of 1.9%, which is more than double what it's done in the previous year. You could see less of that. Futures and options are pointing to less of a volatile reaction today, but still very important to watch the print. The U.S. 10-year yield, very little change right now at 3.43. In fact, all assets are going to be very little change because everything is affected by this, or most everything, and as a result, traders want to wait, sometimes even turn off the algorithms and watch and go through the print with human eyes before making moves. You can see NYMEX crude still at $81 at $81.74 right now, and Bitcoin holding right at $30,000. Gold is holding right at $2,000 as well. So you don't see, even in the dollar, really very much movement. Take a look at some of the movers this morning you talk about, and we're going to talk about the commodities M&A. There's also some M&A going on, really a takeover battle for National Instruments. It's a $7 billion company that makes hardware and software scientists use to measure things. Emerson Electric has made a $60 a share offer, and that could be the winner. We'll watch for that. Bed Bath & Beyond has raised $50 million, almost $48.5 million through the sale of 100 million shares. It's looking to avoid bankruptcy. It's obviously a penny stock, so we see very little movement in the pre-market that results in bigger percentage moves, but we'll watch that at the open nonetheless. Carnival Corp, I think, is very interesting. This is a cruise line whose CFO gave an interview to Bloomberg yesterday, and he said they're not interested in buying or in issuing debt right now at these high rates, but they are paying debt down right now, and we're going to watch for any reaction. The shares not moving much right now. I'll talk about this later with my colleague Paul Sweeney on Bloomberg Radio. He's obsessed with the cruise lines. And then Nutex Health right now up 30%. It has entered into a $100 million prepaid advance agreement with Yorkville Advisors, and it's also a small stock. So as a result, that produces a very big move in percentage terms. Anna, what do you see in Europe?
Yeah, we don't see big moves here in Europe, not at the aggregate level, at least, Matt. We are waiting and waiting for the CPI print out of the US. It's a quiet day besides that. We're up by 0.2% on the Stocks Europe 600. So modest gains being made here this Wednesday morning. Volvo is one stock that really outperforms. This is the truck and bus manufacturer based in Sweden. They have reported numbers that were better than expected. It does seem as if some of the issues around supply chains are in the rearview mirror. Maybe we saw that in the China PPI data we got out earlier on this month. We also see it perhaps in the CPI print later on from the US, the way that this is not about goods anymore. This is about services. And so the supply chain issues that had been such a problem for that sector, perhaps in the rearview mirror now. And here are a couple of FX crosses just to watch as we get that CPI print later on today. One of our colleagues on the Markets Live team talking about the carry available in Hungary right now, given we've seen such high levels of inflation, above 25%. Yes, we've seen a little moderation there, but still the concern is about these incredibly eye-watering high levels of inflation in Europe. As a result, we have high interest rates, of course, over in Hungary too, and we got that inflation data earlier on today. And the euro is fairly flat, really, with a 109 handle, clawing its way back to 109 from that little wobble we saw around the financial services tension, shall we call it. 109.22 for the euro against the US dollar as we wait for CPI, Matt.
Yes, we are waiting. Joining us now to help us wait and watch is Vipul Faljar, SPDR Spider ETFs Vice President at State Street Global, really the behemoth, the first, the original, the OG ETF. Vipul, thanks so much for joining us. What do you see in the flows right now? I mean, there's such uncertainty as we near what we think is the peak of the hiking cycle. How do you see this playing out in ETFs?
Matt, firstly, thanks very much for the very kind intro. So in terms of flows, yeah, it's been a very, very strong start to the year. ETFs in Europe have already seen 45 billion go in. About half of that has been in equities and about a third in fixed income. The real kind of surprise has been EM. I mean, EM has seen flows in Jan, Feb and March and has taken 50% of all equity ETF flows year to date. So a really strong start to the EM space, obviously triggered by that China reopening.
Yeah, so China, a big part of that. Good to see you, Vipul. But talking about the resilience of that EM trade, I suppose, is interesting. I was talking to a guest from BlackRock earlier who was also talking positively about EM, but suggesting that this would stand up in the face of a mild recession in the US, but not something more drastic. And I guess that's where we could see the EM trade diverge later in the year.
Yeah, that's right. I mean, the EM trade is always seen as a bit more of a risk-on trade. Of course, we've seen China do very well in Jan. I think the EM trade has underperformed a bit after that, and focus has shifted to other regions like Europe over US, etc. So I think it's one to keep an eye out. I think in the longer run, we do still like EM, and the growth that's going to come out versus developed markets will be from the emerging market space, we predict.
OK, so something to watch there. In terms of the sectors that you see flows into, I mean, financials had an incredible start to the year. Europe, as a result, had an incredible start to the year. Then March happened and things did not look so good. So have we managed to normalise a little bit, or at least go back to that positivity of earlier in 2023 since the sort of really tough times of March?
I think it's still really early days for the financials, given that it's all fresh in the head what's happened with Credit Suisse and SVB. Financials, surprisingly, have still seen the most sector ETF inflows year to date. March wasn't the case. March, they were pretty much flat. And actually, those sector ETF inflows have turned to sectors like technology. We still think financials are worth keeping on the radar, but it may be a bit too early to go back in, and we'll just let the dust settle a little bit, see what the capital buffers come in, see what the regulators say.
You've seen a ton of money go into money markets, from deposits, obviously, into short duration ETFs, short duration treasuries ETFs from deposits. Is that starting to turn around a little bit? Are you seeing a little bit of a reversal of that trade?
Yeah, so it's really interesting, Matt. Last year was really a kind of treasury year, sovereigns, and then we kicked off this year with corporate debt. Last month, again, it went back to kind of sovereigns and that slight flight for safety, given what happened with the banking volatility. But overall, what we quite like is that short duration investment grade credit part of the curve. Reason being, for example, in the UK, you get about 5.5% to 6% yield in kind of broad UK credit. And then if you've got a short duration of kind of 2.5 years, we think the risk reward there is pretty solid.
One of the other big moves that we've seen in the ETF space, over a longer period of time has been the conversion from mutual funds into ETFs. How much more do we expect to see that? I mean, right now, I think globally, the ETF market is about $10 trillion, I should say. How much can that grow?
So time and time again, Matt, when we speak to investors, they just really appreciate the fact with the ETF space, you can get that real timely activity in, and you don't have to obviously wait when it comes to the mutual funds in terms of kind of putting your trade orders in. And I think in this kind of generation of kind of instant and very time-sensitive activity, ETFs can only grow in terms of that activity. And we're seeing more and more of those kind of conversions happen.
Okay, and then back to the story sort of flows within ETFs and what you're seeing. We're heading towards earnings season, and there's a lot of focus on whether we get to an earnings recession, the amount of pricing power that companies have right now. How do you see investors positioning ahead of yet another earnings season?
Yeah, and I mean, look, last quarter was pretty tough in terms of earnings beats. You know, they were the lowest, I believe, since sort of the start of COVID. Again, we're going to head into a kind of downbeat kind of earnings segment here. I think we're predicting 6.3% down. In terms of how investors are positioning, I mentioned last month the biggest inflows were into the technology sector. Funnily enough, they're seeing technology as more of a defensive sector at the moment, because if we do see a situation where the Fed tends to cut rates even more aggressively, of course, that's where the tech sector will come in a bit more in terms of its performance, like we've seen year to date.
And a lot, as you say, a lot riding on where the Fed goes in 2023 and into 24. Where do you stand? I've been waiting for the CPI data today. It's the big data point of the week. Where do you see the narrative around whether the Fed cuts later in this year going?
Yeah, it's a big question right now, and all eyes are on the CPI data. So we predict towards the end of the year, we'll see 50 bips worth of cuts. And where we're slightly away from the street is we expect the Fed to pause in May. So I know that people are pricing in a 25 bip rate hike. We think, given what we saw last month with the banking volatility, that's done a bit of the Fed's work. So it's time for, in our sort of opinion, for the Fed to pause and then wait to see towards the end of the year where we get about 50 bips worth of cuts in December.
Okay, Vipul, thanks very much. Thanks for joining us. Good to speak to you. Vipul Faujda of State Street Global Advisors. Coming up on the programme, we'll get another view on CPI and the Fed. Silvia Ardagna joins us, Chief European Economist at Barclays. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with the UK Chancellor of the Exchequer, Jeremy Hunt. That conversation at 4:30 p.m. New York time. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, investors are counting down to today's US CPI data, which is expected to show inflation eased for the 9th straight month. Goldman sees stocks dropping at least 2% if the year-over-year rate comes in above the previous reading of 6%. Joining us now is Silvia Ardagna, Chief European Economist at Barclays. Silvia, very nice to speak to you. We'll get to Europe in just a moment, but focusing in on the big data point of the day, of the week, and that is US CPI, of course. You expect, I think, like the street, 5.1% on headline year-on-year inflation. What are you going to be watching out for? There's a lot of focus on the super core, on services. What holds the key for you for inflation?
Hi, Hannah. Good morning, and thanks for having me here. Yes, the key for us is really the components of this print. We are expecting core inflation at 5.6, with the month-on-month print at 0.4%, so slightly below what we get last month. And we will look for goods inflation to remain on the firm side, but service inflation to begin to moderate. And that's, if it happens, it's a good news and a welcome development, because service is clearly key for this inflationary process to be on a more steady pace.
It's really quite incredible when you look at the development of the components of inflation. I mean, we're talking about the US here, but to some degree this applies elsewhere. The way that this was very much a supply chain and goods story a couple of years ago, and really now it is not, is it? It's almost all in services, food as well, but services very much the heart of this. That's labour costs as well coming through there, I suppose.
Yes, there is some, but I would say that across the world there is a difference in the various jurisdictions. Clearly, labour costs have gone up much more in the US, in the UK, than in the euro area. In the euro area, wage growth has remained still at levels that are, we would say, consistent with the ECB inflation target of 2%, and we really don't see any wage price spiral. And indeed, in the euro area, when we look at the components, the core goods inflation has remained more stubbornly high than the service.
It does seem like we're hearing from more and more people, Silvia, that this inflation whether we're talking about U.S. inflation from the view of BlackRock, Anna was speaking with Wei Li on Bloomberg Radio this morning, or European inflation from the view of the ECB, it's going to be sticky. We're going to be sitting with this inflation for years. Do you share that view?
I mean, we share the view that it's going to be sticky in the sense that it will take a few more months before it goes down more significantly, particularly in the euro area. But we don't agree with the statement that we are going to live with it for years. I mean, in our own forecast for the euro area, we have inflation going down to 2% at the end of next year. And we really think that the central banks are committed to bring it down to 2%. So in our forecast, we see even core that is going to remain elevated above 2, continuing to decline and decline toward the central bank's objectives.
What kind of recession does the Fed need to put us into to get inflation down to 2%? Because the concern here is that, even a couple of non-systemically important banks facing runs made the Fed rethink their rate-raising path. So if you have real problems, they're not going to have the resolve.
Well, in our forecast, we have a recession in the U.S. economy that starts with a negative GDP print in Q3 and lasts until Q1. But by historical standard, it's quite a moderate recession with some increase in unemployment, but again, still at very low levels. And we think that the Fed will hike one more at the May meeting, and then it will leave the federal funds rate at 5.25 range for a significant period of time, I would say more than what the market expects. We have the Fed on hold until the beginning of next year, and that, in our view, is sufficient to generate the slowdown in economic activity that is needed for inflation to come down to 2.
What do you think, Silvia, would need to happen for the Fed to cut? So you've set out your path ahead, one more hike maybe in May, and then a pause until the start of next year. One of my colleagues on the Markets Live team was talking earlier on about how he thinks we need to see real yields in positive territory, a number of different measures of that, of course. But for him, that needs to gain sort of more ground before we'll start to see the Fed cutting. That's not necessarily their mandate, but that's what he's looking for in market terms. What are you watching for to allow the Fed to sort of make that move to cutting?
I mean, we have the Fed beginning to cut when, indeed, we see inflation coming down, quite significantly, and we see the unemployment rate beginning to move up. Because if the Fed were not to cut, then policy would be so much restrictive that we would risk having too much of a deep recession and inflation going down, way below where it should be in the medium term. So we would agree with the view that, again, if the Fed were not to cut, real rates will become way too positive. And again, you can measure them depending on different metrics of inflation. But if you take the one-year inflation based on our forecast, we would have, that the Fed would need to cut at the beginning of next year.
Silvia, can I ask you about the availability of credit? I've heard a few statistics in recent days, both survey data and also loan data, that give me pause. Are we facing a credit crunch? Is the availability of credit in danger right now?
We did a very, I would say, deep analysis of the transmission channel of monetary policy through the credit market and the real economy. And I would say that what stands out is the fact that monetary policy is working. We see that financial variables, including all the credit data, are responding to monetary tightening. So we have a slowdown in credit creation from hard and survey data, both in the US and in the euro area. Now, whether you want to call it a credit crunch, perhaps it's, it depends on your definition. In our world, what the credit decline that we are going to see is what is sufficient, right, to what is, first, it's a byproduct of the monetary policy tightening that is needed to cool down inflation. And second, part of it will be also generated by what we have seen in financial market recently. Clearly, banks' officers are going to be more risk adverse, and they are going to tighten lending standards more than they would have had if there was no turmoil in financial markets. So for us, the turmoil is worth everything between 1 and 2 hikes, in the US and in the euro area that we have removed from our baseline forecast because the credit crunch is coming endogenously from the financial market development.
Sylvia, thank you very much. Really interesting detail there on the provision of credit then in various global economies. Silvia Ardagna of Barclays joining us to talk about the CPI print ahead and much more. Just want to flag something that's happening right now that we are monitoring. The CEO of Binance, that is Changpeng Zhao, of course, is speaking in a fireside chat at the Web3 Festival in Hong Kong. We'll continue to monitor his remarks, bring you any headlines that are generated from that conversation. You can watch the event on Live Go on the Bloomberg terminal. This is Bloomberg.
About the security and they trust the platform. I think the next question is, I take exchange, for example. Exchange is one of the gateways to get people into crypto or Web3. And I think it's fair to say.
I think what's driving the steep rise is a flight to safety. If you look at the correlation of Bitcoin, it's traditionally in the past few years been very correlated to the NASDAQ and to the S&P. We're now seeing it decorrelate from the NASDAQ and S&P and correlate much more to gold. With the banking crisis, many people realize that this is really what Bitcoin was born to do. It was born to be an asset where you control the keys, you hold your money, and nobody else does.
That was Fred Thiel, the CEO of Marathon Digital, a crypto miner, speaking about Bitcoin's recent rally on Bloomberg Crypto yesterday. And right now, the CEO of Binance is speaking in a fireside chat at the Web3 Festival in Hong Kong. You can follow along with that if you want on your Bloomberg terminal. You can just type in Live Go and watch what CZ has to say. Of course, all the more interesting ever since Anna, the CFTC filed suit against CZ and Binance, saying that they are encouraging or helping clients to get around certain regulations. In terms of Bitcoin and the run-up that we've seen to $30,000, I think it's really interesting that investors are choosing this as really kind of safe haven or a store of value, especially considering the volatility we've seen in Bitcoin in the past. Yeah. I showed at the beginning of the program a chart that measures the gold ratio to oil and how that climbed in March of 2020 and is now climbing back up again. The Bitcoin to oil ratio is very similar, with the exception of a couple of stimmy spikes that we see during the pandemic. So I think it's fascinating that investors really are taking to this asset.
Yeah, it is. I mean, how much of it is about the sort of anything but fiat arguments that maybe have been given a boost in the views of some by what we've seen in financial services in recent months? And how much of it is just a play on the Fed and more people expecting cuts from the Fed? And so there could be that cyclical element to it. But regulation has got to be something that hangs over the sector, Matt, as you alluded to.
Yeah, I think regulation very much does. In fact, we heard from Fred Thiel yesterday that in his view, the U.S. is trying to put an end to crypto mining and the crypto industry in the U.S. And so they're looking at other places to do business. But, you know, the idea that the Fed is done cutting rates and they may come down, that helps to boost Bitcoin. That's also helping to boost gold. So I think it's very interesting, the similarities there.
That's it for Early Edition. Surveillance is up ahead. They will be hearing from Tim Adams, President and CEO of the Institute of International Finance. They'll keep you across all of the Washington developments from the IMF, of course, as well. This is Bloomberg.